Next question. The following is the capital structure of a company. So capital structure of a company is given. Source of capital, in that equity shares of rupees 100 each, it is 80 lakhs and the market value is 160 lakhs. Next information is given to us like this. 9% cumulative preference share. So 9% cumulative preference share of rupees 100 each. So we have been provided with the preference share capital information, which has a book value of 20 lakhs and market value of 24 lakhs. 11% debentures, book value of 60 lakhs and market value 66 lakhs. Retained earning is 40 lakhs. The question says that the current market price of the company share is rupees 200. So basically this is given as P0. For the last year, highlight the portion last year. The company had paid equity dividend at the rate of 25%. So please use your calculator. We understand that say the 100 rupees is a face value. And we have been provided with the information that say rate of dividend is 25%. So the D0 is given as rupees 25. That is 100 into 25%. And the dividend is likely to grow at the rate of 5% every year. Growth rate is given 5%. The corporate tax is 30%. And highlight the portion, shareholders personal income tax rate is 20%. So this is a new information given to us. Dear students, this information is going to be useful for making calculation of the cost of retained earning. How it is going to be useful, that I am explaining to you say in the time to come. There are 3 questions provided to us. You are required to calculate cost of capital for each source of the capital. So we understand it is equity share capital, preference share capital, debentures and retained earning. Calculation of the weighted average cost of capital on the basis of book value weights. So the question says that say using the book value weights, compute the weighted average cost of capital. Again, compute the weighted average cost of capital on the basis of the market value weights. So in the third question, again we are required to find the weighted average cost of capital, but this time market value weights. I request all of you to go through the question and then we'll discuss how to do it. Dear students, over here we can see that the question provides that say we are required to calculate the WACC using the book value weights and using the market value weights. So we understand that say the weighted average cost of capital can be calculated by 2 bases, either based on the book value or it is based on the market value. It is good that in this question there is a clarification provided to us. If at all such kind of clarification is not made, listen carefully, if such kind of clarification is not made, then in that case, how to do answer? Then replying to that kind of question, if at all the clarification is not made, then in that case, you can do answer by either of the method. Generally, we have to do book value method and we will put a note for the same. Generally, we will follow the book value method and we will put a note for the same. Because basically the clarification should be made in the question when weighted average cost of capital can be calculated by more than one method. Because the concept is that say we can compute answer by more than one method. So clarification should be there. If it is not there, then in that case do answer by either of the method, preferably book value method, and you can put a note for the same. So let us have understanding that say now how to make the calculation of the answer. The question number 1 is you are required to calculate the cost of individual source of finance. So I want you to make the calculation of the cost of equity and put your answer in the chat box. So let us answer for the first question. Calculation of K. K stands for cost of equity. In the breakdown, working note number 1, calculation of D0. D0 is found as face value of equity share into rate of dividend. Face value of equity share is rupees 100. Rate of equity dividend is provided to us as 25%. That comes to rupees 25. Working note number 2, calculation of D1. It is D0 into 1 plus C. Just pay dividend is 25 and growth rate is provided to us as 5%. So what will happen? 25 into 1.05, 26.25. That is the way so the D1 is calculated. Next, calculation of K. It is D1 upon P0 plus growth rate. D1 is 26.25 divided by P0 is 200 plus growth rate is 0.05. So it is 0.13125 plus 0.05. So 0.18125. So it is 18.125%. That is the way the K is calculated. Next is preference share. I want you to calculate the answer of the preference share and put your answer in the chat box. Dear students, the question is not providing the information regarding the redemption of the preference share. So we assume that the preference share is issued for perpetuity. Accordingly, the answer will be found. That is the first thing. Second, we have to understand that we are required to compute the cost using the existing market value of the security. See, understand logically like this. I am giving you a detailed explanation over here first of all to you. See, 20 lakhs is the preference share capital. Face value of the preference share is 100. It means that the company has issued 20,000 preference shares having face value of 100. Market value of the preference share is 24 lakhs. 24 lakhs divided by 200. I'm sorry. 24 lakhs divided by 20,000. So the market price of the preference share is 120. It means that the question is providing the information that the current market price of the preference share is 120 rupees. Existing preference share has a rate of dividend of 9%. What does it mean? It means that today, if at all we issue a preference share having face value of 100, offering the rate of dividend of 9%, then in that case 9 rupees will be the amount of the preference dividend, and listen carefully, we will fetch 120 rupees from the market. So the cost of preference share will be 7.5%. That is what we have to understand. We do not have to calculate cost of this preference share. we have to compute that, say what will be the cost of the preference share if today we will issue such security in the market. We have to compute the cost of preference share considering, say, the base of the existing security which we have in the market. And if at all we issue such security now in the market, what will be the cost is what we understand is the cost of preference share. Write down heading calculation of KP. In that, write down first point, assuming that preference share is issued forever, comma, answer is found. Second point, always remember that we take base of existing preference share to compute KP, full stop. It means what will be KP if the company will issue such security in the market, full stop. In that, write down further, new security will be issued at current price. So we assume that, so the new security will be issued at current price. So KP is preference dividend divided by amount. So the amount of the preference share capital is 20 lakhs. Rate of preference dividend is 9%. Divided by the amount is 24 lakhs. So 9% of 20 lakhs comes to 1,80,000. Divided by 24 lakhs into 100 for getting answer in percentage term. That is 7.5%. Because either you do working for in total or you do answer for per share, it is one and the same. Write down answer KP. I want you to tell me answer of the KD in the chat box. Dear students, again we will make an assumption that the debentures are issued for perpetuity, and accordingly we will calculate the answer because the redemption information is not given. So write down answer, heading, write down calculation of KD. In that write down assuming that debenture is issued forever, comma, KD is found. So the answer is interest into 1 minus T divided by amount. See, the face value of the debenture is 60 lakhs. Rate of interest 11%. I'm sorry. Income tax rate is 30% divided by 66 lakhs. So what will happen, dear students? 60 lakhs into 11%, that comes to 6 lakh 60,000 into 0.7, that is 4 lakh 62,000 divided by 66 lakhs into 100, that comes to 7%. So KD is 7%. Right on answer. Dear students, these three are the questions exactly the way we have understood. There is no change. Now there is a new point that we have in case of the retained earning. The question is providing the information about the shareholders' percent tax rate. In that case, how to do answer? Let us understand. I request all of you to write down answer. Calculation of KR, cost of retained earning. In that case, we have to work out the answer like this. Cost of equity into 1 minus personal tax rate of the investor. What is cost of equity? Cost of equity we already have found. It is 18.125 into 1 minus 0.20. So it is 18.125 into 0.80. That comes to 14.5. That is the way, so the cost of retained earning is calculated. See, the calculation is very simple. However, let us have understanding. Let's say, why do we do answer like this? TP stands for personal tax rate of shareholder, or we can say it is of investor. Now, let us have understanding importantly like this. Let us assume that say the company is having say an amount of retained earning of 1 lakh. Let us assume that say the company retains an amount of earning rupees 1 lakh. Shareholders are expecting that, listen carefully, shareholders are expecting that say on this amount you should give return to us at the rate of 18.125%. However, this calculation says that say no, the cost of the retained earning to the company is 14.5. Let us understand why. I hope that everybody is clear. That's over here. So far the working that say we had done, in that cost of retained earning was considered to be same as cost of equity with the only change in the flotation cost. So far working, or we can say that say whenever the personal tax rate of the shareholder is not given, Still the cost of the retained earning is 18.125, that is cost of the existing shares, but not if the personal tax rate is given. Why? Company tells to the investor like this: if at all we pay this amount to you in form of dividend, then in that case you are required to make payment of tax at the rate of 20%. So you have to pay tax of rupees 20,000. So basically you would have in your pocket an amount of rupees 80,000. This amount of the 80,000 that you have in your pocket, so that you can invest somewhere. And we do understand your opportunity cost is 18.125%. So investing this amount somewhere else at 18.125%, it will have, so the amount of the earning like this: 80,000 into 18.125%. You will have earning of 14,500. Listen carefully. When we retain this amount, you get capital appreciation of the security. And when you sell your investment, the capital gain income is exempt in your hands. So basically, we are responsible to give you, say, the earning of 14,500 on every 1 lakh that we reinvest in the business. So the cost of retained earning to us is 14.5%. We have an obligation to give you a return of 14.5%, because this is what, say, you could have earned otherwise if at all we pay this amount of the earning to you in form of dividend. That is the reason, so the cost of retained earning, if personal tax rate information is given, is 14.5%. Write on a small explanation. For KR, that is cost of retained earning, if personal tax rate information is given, comma, we assume that investor will have to pay tax on dividend income, but not on capital gain. Full stop. Company is responsible to cover income forgone by the investor at the rate 14.5%. This is what we understand. So friends, now we understand, let's say we have computed cost of the individual source of finance. Now we are required to make the computation of the weighted average cost of capital, and for that, say, we are required to take the book value weights. So you can very well understand that, say, 80 lakh rupees is the equity financing out of, say, 200 lakhs. So 80 divided by 200, this comes to 0.40. 20 divided by 200, so this comes to 0.10. 60 divided by 200, that comes to 0.30. 40 divided by 200, that comes to 0.20. That is when the proportion will be calculated for individual source of finance. We already have got the cost of capital. So weight into cost, weight into cost. weighted average cost of capital will be found, and that is what we understand is the answer for second part of the question. So write down answer. Calculation of WACC using book value proportion. So we will have column number 1, source of finance. Column number 2, amount. Column number 3, weight. Column number 4, cost. And the last column is weight into cost. That is the way the weighted average or overall cost of capital will be found. Try to calculate answer and put your answer in the chat box. So in source of finance column we will have equity share capital, then preference share capital, then debentures, and then retained earning. Amount is an amount of 80 lakhs, then it is 20 lakhs, then it is 60 lakhs, then it is 40 lakhs. Total is 200 lakhs. So the weight would be calculated as 80 divided by 200. That comes to 0.40. 20 divided by 200. That comes to 0.10. Then 60 divided by 200. That comes to 0.30. And 40 divided by 200. That comes to 0.20. And total would be definitely 1. Multiplying with the respective cost, it is 18.125, then it is 14.5, this is 7.5, and this is 7. That is the way we are required to consider the cost. KD is 7 and KP is 7.5. Okay. So now we'll have the working like this. Weight into cost of capital. So the weight of equity is 0.40 into 18.125. That comes to 7.25. 0.40 into 18.125. Next it is 0.75. So 0.10 into 7.5. Then it is 2.10. 0.30 into 7. Then it is 2.9. 0.20 into 14.5. That is the way the weighted average or overall cost of capital can be found. So the final answer would be 7.25 plus 0.75 plus 2.10 plus 2.9. That is 13%. This is the way weighted average or overall cost of capital is found using the book value proportion.